Hey, good afternoon. Welcome to our very first podcast at One Legacy. Alison, thank you so much for joining us today and being our special guest today. Alison is from Elevated Mortgages, and she is a mortgage broker with over 5 years of experience, I believe.
Mhm.
And she's very passionate about mortgages and helping clients get into homes. And she deals with all the financial side. She's located both in Edmonton and also in Calgary. So, Alison, welcome aboard.
Thanks for having me, Andy.
So, I know that today's podcast style, I'm going to be asking you some juicy questions in terms of what the public wants to know and not just your surface level questions. So, are you guys ready for this? You better be. So, number one question, Alison, that I want to ask you is what is the biggest misconception people have about being pre approved?
I think the biggest misconception would be thinking that you're fully approved for a mortgage, when in reality, a pre-approval is often just like the first step. So most lenders haven't verified everything yet. It's really sometimes even just a review, or if it's pre-qualification, it's really just a review from the mortgage broker of what you've submitted. So I think it's very like at face value that the lenders see during a pre-approval. Plus, they're only looking at things like what we've submitted. Sometimes that's not even income documents, down payment documents. They haven't seen the property yet either. So you know the full approval really doesn't come until later when you found that property and everything gets reviewed.
Okay. What is the difference between a pre approval and having a fully underwritten approval? Because I know that
Yeah.
a lot of times, you know, buyers are very excited, right? And agents are also, who are helping the buyers, are also very excited. So, what do you find is the major difference between the two? And even the terminology that you mentioned, like pre qualified versus pre approved?
Yeah, so a fully underwritten approval means the actual underwriter has reviewed all the supporting documents. So, income documents, down payment, they reviewed the property itself to make sure that it meets their lending guidelines. And then the pre approval is really just like a face value review of what's been submitted. And sometimes that doesn't even include documentation.
Yeah, no, amazing. And then how often would you say that buyers get surprised after being pre approved, that when they go shopping and that they find out that, hey, I'm actually just pre qualified, not pre approved?
Absolutely. More often than you think. Sometimes we could even send somebody out shopping just on the pre-qualification, because sometimes it really is dependent on the property itself. So yeah, I mean, usually it's not something that they did that was wrong. It's that when the lender finally sees the file, they discover something that wasn't reviewed up front, or maybe income was calculated incorrectly. There was something about the property itself that is not part of their guidelines. So yeah, it happens more than you think.
Oh, so there's definitely a lot of information on the internet, right? So it's great that, we
Yeah.
have an expert like you that's coming here and sharing us, pulling back the curtains of what the lender side sees and what are
Mhm.
the document qualifications that they're looking for. Now, with that being said, though, what sort of information would you say that the lender is needing verification on, that they're not getting verified on upfront, that most of the time that buyers are unaware of?
I would say income is a big one. It's not something that is always submitted upfront with a pre-approval. There's some lenders who will do a fully underwritten pre-approval. You can submit the documents if you want, but most of the time we're just submitting the application. We're as a mortgage broker, we're reviewing the documentation, and then kind of giving the green light to go ahead. And then there's other
Mhm.
lenders who don't even look at the file. It comes in and they're just like, okay, we put it on the side. We'll do the rate hold for 120 days, but they don't even look at it.
Oh, okay. Yeah, that's very interesting because I know
Mhm.
that there's mortgage calculators online that a lot of buyers use it as a resource, and they plug in some numbers and it spits out a pre-approved amount. And so what you're saying then is, it's not 100% accurate. And it's by no means that they've verified any information that says you can actually afford for this amount and go ahead and rest assured and go shopping. Is that what you're saying?
A little bit, yeah. Sometimes, like, as a mortgage broker, that's our job. We review the documents up front. Like, I personally request all documents up front for every pre-approval. So I'm like reviewing it. I use my experience to say, yes, this is how we're calculating income. And then we even, double check with the lenders to make sure, like, hey, is it okay? Will you accept an exception if I do like a 3-year average instead of a 2-year, given the certain parameters? I feel like every file is different. So, it's up to us to kind of distinguish how we're going to do an income calculation, which is why I'm saying income is usually a big one because there's so many things that are happening right now. Like people switching jobs, like after 2 months of working at one firm and then switching to another one. And then okay, they're in the same industry. How do we calculate the income? Do we do a 2-year average? Oh, maybe it makes more sense to do three if something happened in a year. So it's up to the individual mortgage broker to really figure out how best to calculate the pre-approval and go forward.
If you're doing like a 5-minute online calculation of like a mortgage calculator that the buyer's clicking through, again, that should be a yellow flag or even a red flag for buyers out there saying,
Yeah.
don't go shopping yet. Go through the full process where documents are submitted to your mortgage broker or your lender so they have a better financial picture of how to position your file and at the same time be able to recommend options for you. So
Yeah.
that's really good. Number two, I wanted to ask you, I know a lot of people are wondering, is what are buyers doing between pre approval and possession that unknowingly kills their financing or kills the deal?
A few things. Either they're changing their financial situation, like they're adding debt, they're changing jobs. Yeah, anything that changes. I think like one of the things that people don't consider is that a lender can pull your credit before closing. So if they pull credit and they see something on there that wasn't in the original application or numbers have changed completely, like your line of credit went from 2 grand to 5 grand, that can really change numbers and it can really impact the financing.
Right, 100%. Would it be a good idea to buy a vehicle then, like during
Mm,
your process of getting into a home?
absolutely not. That is a large payment that can really just like squash the deal.
Yeah, for a real estate agent, when you go and show homes, after they remove conditions or whatnot, and looking at homes, or looking at the home that you remove conditions on, that's you get a heart attack when they pull up in a brand new vehicle, and you're like,
Yeah,
"When
no
did you
kidding.
buy that?" Right?
Yeah,
So, even before they take in possession, so don't do that, guys. Not a good idea.
definitely involved.
Yeah, yeah, absolutely. You don't want to be stuck in a pickle there, so and not be able to close.
Yeah.
What about things like lower ticketed items like furniture, like financing furniture? Would that be something that would impact your borrowing power or financing?
Yep. So same sort of thing as the vehicle. Like if we see another additional debt, or even like the buy now, pay later type thing, or a firm, even with Amazon, where people are starting to buy, like whether it be pots and pans or purchasing something on Amazon and then using a firm, we can see
Mm.
those amounts in your bank statement. Or if like you're getting the mortgage through the bank that you bank with, and all of a sudden they see this additional debt, could be an issue.
Yeah, 100%. And I've also heard as well that during the time that before you close, that don't apply for any new credit, like credit cards,
Mhm.
like anything like that, because that's going to change your debt service ratio and also your borrowing power ultimately. So, based on your career, like what would you say the craziest financing disaster you've seen right before closing is?
Uh, there's some where it's like delayed funding when really it wasn't even something on my side. Or I've had a deal where the financing didn't close on so like I had a client, they were selling a home and then buying a home. And they didn't end up the seller or the buyer for their sale didn't end up pulling through. So that completely collapsed.
Mm.
It's crazy what we see, but I would say one of the biggest ones was not even something in my control, something I've never seen before. It was the day before closing, and the bank had requested just randomly for the middle names of the clients to be added to the mortgage. And so it wasn't
Mm.
even my side. They'd asked the lawyer to do it. So then all of a sudden they had to come back into the office, sign with new documents with the lawyer. So it delayed funding by I think it was 4 or 5 hours, and yeah, it ended up costing them a little bit in interest, but We
Right.
pulled it
So
off.
nothing.
It's
Yeah,
you really can't control what you see these days.
100%. And that's not even the homeowner's fault, right?
No.
That's
Yeah,
more on the
really nobody
lending
involved. It's
side.
just yeah, one of those crazy things that just, like, randomly happens. I mean, there's so many things that we see, and yeah, you just kinda have to roll with the punches and figure it out.
Yeah, 100%. That leads me to the next follow-up question to that is, what do lenders know about borrowers that borrowers don't know about themselves?
I think pattern recognition is a big one that lenders see, and then more borrowers just think it's a decision. Um, so, like, something like, maxing out credit cards, or, like, we can see this stuff in the credit history, um, or, you know, not insufficient funds, but, like, going into the negative in your checking account. Like, simple things like that kind of just show that the behavior over time is that you're not managing your money well. So I think that's
Mhm.
something that lenders are really like diving into. That's why they dive into the bank statements, they dive into the credit history. And I think that's not something that's top of mind for a lot of the borrowers.
Yeah, so when you say they dive into it, like, how far do they could potentially go back?
I would say mostly they focus on the last 2 years of credit history. Like if something like all the time we see that things have happened in the past, somebody lost their job and chose to default on their car versus defaulting on their house. Like those stories make sense. And it
Mm.
shows that you were focused on the bigger debt, which was the mortgage, and then you got rid of the car. Like I've had that quite a few times. So like all of that makes sense. People lose a job and then all of a sudden their credit cards go high and then they, default on them and can't pay them. um, so yeah, it's all about like we kind of like put the story with the person in what we do.
Mhm.
So we can explain that away. I think the biggest thing is the last 2 years. If there's any missed payments, if there's frequent overdrafts, high credit card utilization, unexplained, like large unexplained deposits, they look at all of that sort of stuff that happened in the last 2 years on credit history or 90 days for bank statements.
Right. So for the audience that's paying attention, all those things that Allison had mentioned are potential red flags that underwriters seek out immediately. Like to them, they're
Mhm.
trained to look for these kind of things and look for these patterns. So you'll want to make
Yeah.
sure that your credit score and your payment history and all that, even if you can't pay the full, payment in full, but even making your minimum balances and all that is crucial because rather than build your credit score, it might, if you don't miss a payment, it actually might hurt it, and it takes a while before you rebuild it, right? So that's
Mhm.
definitely something to kind of keep in mind. But another thing that I want to ask you is like for borrowers or lenders in this sake, what are you finding that some of the credit score myths are that are surrounding this internet and out there in the public? What sort of myths have you been hearing about in terms of the credit score?
I would say I have a list. I think like a big one is that people think I have a high credit score, I'm automatically approved.
Mm,
But high credit score, we still have to look at the debt ratios. If the debt ratios don't make sense and they're too high, then you're not automatically approved just because you have a high credit. Or high credit means the lowest rate possible. Not always the case. Sometimes yes, but I would say a few other myths would be that pulling your credit will damage it. So for mortgage financing, you can actually pull your credit a few times because they understand that you're going to shop around for the best rate. So you can actually pull it a few times within 45 days and only hit your score once. We'll
mm,
still see all the pulls, but it will only actually impact the credit score once. Um, I think another misconception or myth is that accepting a credit increase on like a credit card or a line of credit will like hurt your qualifying, but really it's about utilization. So if you have access to like let's say $50,000 worth of credit, but you're only using 10, 15, 20,000, you're staying below 50% of that authorized limit. You're actually improving your credit score because your utilization score is going up. um, the credit score is really only a piece of the puzzle. It's how you utilize and how you use your credit that we're looking at.
Yeah, because I think lenders are looking at it as what you mentioned earlier, how responsible you are with utilizing or leveraging money, right? If you're
Exactly. Yeah.
someone that is not 100% in managing their finances properly, doesn't mean that you don't have options. It's just a little bit more trickier to build a case when it comes to putting your file in front of the lender and explaining why, right? And as long as they
Mhm.
understand, then it might satisfy what their criteria is and still be able to approve you. Maybe not for a high amount that you anticipated, but maybe a lower amount, but it'd still get you into a home that you can now build a
Mhm.
foundation, right? So, with that being said, what patterns make lenders extremely nervous, even when someone has, let's say, high income?
I would say more money sometimes equals more problems. So if someone's
Mm,
a high income earner, but they're still utilizing their credit to the maximum, vehicle loans, personal loans can even be risky. So someone who like, let's say somebody's only making $90,000, but manages their money more conservatively. That's a green flag compared to someone who's making $200,000 but has a high utilization of debt.
right, that makes sense. It's not how much money you make, it's how much money you keep, right?
Yeah,
So,
exactly.
absolutely,
And how you
that
use it.
makes perfect sense. Yeah,
Yeah.
absolutely. Now, if you could see every mortgage application in Edmonton and in Calgary, what patterns would separate people who build wealth from people who stay financially stressed?
So I would say the financially stressed group buy at the top of their budget. They go with what the bank says they can afford. The wealth building
Mm,
group, uh, they buy what keeps them comfortable or maybe something that they can invest in and leaves themselves room to invest. I would say the wealth building group asks the question of, or more like states, hey, this is my budget. And when I hear like, hey, this is my budget for the mortgage payment, I'm like, cool, ratios are usually very well in line. But the financially stressed, they're asking, what's the max I can afford?
yeah, I think we get that a lot in terms of the real estate agent space. They get the top
Yeah.
number and it's like, okay, we're ready to go shopping, assuming they're able to pre-approve for 600,000. They're like, yeah, let's go look at properties at 600,000 range, right? Even though
Hmm.
just because they can afford it doesn't mean that their risk tolerance or their comfortability is at 600,000. And I think that's part of our role as a real estate agent is to make sure that our clients understand that this is your commitment financially on a monthly basis. Are you comfortable with that? I mean, at the end of the day, we don't have to shop at the high end of their pre-approval. We could shop at $500,000 home or even less,
Yeah,
right? And I think
exactly.
that's where we do our part as real estate agents and in making sure that that we don't put our clients in a difficult situation where they're financially stressed and end up having no choice but to either sell their home in the near future or it's going to cause other issues down the road for them. You know, financial stress is definitely a real thing. So we take that
Yep.
very very seriously. Um so I we've already touched on this. Like I was going to ask you,
Mhm.
is buying the maximum house that you qualify for a mistake? I think I got a pretty good picture is it might not be a mistake. It depends on your, you know, your tolerance as a homeowner. If you can tolerate that, by all means, right? The numbers work, it makes sense. We crunched them, did our due diligence. Lenders are willing to lend, you know?
Mhm.
But if
Yeah.
you're not comfortable with that, then go with a slightly lower price point and have that peace of mind and be less financially strained.
And every situation's different. Like sometimes we have people with two jobs, and maybe one of those jobs we can't even include the income for. But I've seen it before where it's like we're qualifying them based off the one job they do, but they also make $28,000 in a side business that didn't help qualify the application. Like we couldn't use the income.
Mm,
So
right.
like usually yes, buying the maximum house you can qualify for is sometimes a mistake, but sometimes it makes sense where it's like okay, there's
Yeah.
additional money that we didn't calculate for. So yeah, going to the top of your budget makes sense.
Yeah. Absolutely.
Yeah.
Um, what do you say, Allison? What do wealthy people do differently when financing real estate that you're noticing?
Um, I would say wealthy people don't rush to pay off every dollar of their mortgage debt. Instead, they make sure, like, they focus more on cash flow, making sure their money is working for them, and working efficiently among like their investments, real estate, business opportunities, maybe utilizing like RSPs and stuff like that. So I would say they understand finance, they understand leverage, they know how to use it correctly. Yeah, that's how yeah, definitely how I see it.
Yeah, definitely. Whether they're more financially educated than, let's say, non-wealthy or the average middle class.
Mhm,
But there's definitely strategies out there that could help, either that they can leverage from or position that their portfolio based on their goals and objectives that, a lot of times we might not know exist, especially a lot of government sponsored programs that's available
mhm,
out there. Um, one of the things is, as you know, Allison, that was newly introduced is like the new build GST rebate, right?
mhm,
That's something that you could potentially save 5% of GST on a new build that qualifies. That's a substantial amount.
yeah,
So if you're someone that is wealthy and knows how to leverage money, I mean, that could be beneficial to the bottom line when it comes to investing.
yeah, absolutely.
Yeah, for sure. Question number 5, Allison, is what's the mortgage advice that sounds wrong but is actually true?
Um, I would say just because you have money available doesn't automatically mean you should put it all towards your mortgage.
Mhm.
I think it's like a misunderstood concept in personal finance. Like people want to pay down their mortgage as quick as possible. But I mean, if you're paying 3.5% on your mortgage, you could be putting that money into something else that's growing. So I fully believe in, a dollar in your pocket is way better than
Mm.
trying to pay down that debt immediately. In some situations, it's different, but I definitely believe in investing and forward thinking and putting into those long-term goals.
I think that's where Robert Kiyosaki has differentiated that there's good debt and bad debt, right?
Yeah.
Assets and
Yeah.
liability for that reason. Yeah,
Yeah.
that's 100% true.
Mhm.
Now with leveraging debt, can having no debt actually hurt your ability to get financing? What's your take on that?
Yes. Well, because lenders wanna see that you have a credit history. They wanna know that you can manage it properly. So sometimes having no debt whatsoever is actually worse than having it. So
Mm,
yeah, we wanna see you manage it properly. We wanna see how you pay it down. We wanna make sure you're not missing any payments. We wanna make sure you can utilize it properly. So, yeah, absolutely, having no debt can be worse.
yeah, I've
And
heard
if
that.
you have a 0 credit score, it is much harder to get financing, if you can get financing at all.
Yeah, I've run across a couple situations where the buyer that I was talking to as well paid everything in cash and
Yeah.
haven't used a credit card, doesn't like to use credit card. And when they pulled their credit, his credit score was very, very low. And he wanted to get financing and he wasn't approved.
Mhm.
And for viewers that are listening in, it's like there might be a sense of like, how dare them? Like, there's why aren't they lending on someone that can pay cash for it, right? But
Yeah.
lenders look at things differently. They base it on the credit score. They want to know the story. Just because you can pay cash for it doesn't mean that you manage cash well as well. Even though that
Mhm.
there's a slight chance that that's not true. But with people that like to save as well, because I know that there's when you buy a house, there's a portion where you have to that it could be allocated to CMHC for default insurance. A lot of homeowners are looking to save at least 20% in terms of down payment before they feel ready to buy and not having to pay the insurance. So, is a bigger down payment always better in your opinion?
No, not always. Like, the way I see it is the reason we want to see the full picture is, or for an example that I had yesterday, they had $7,000 owing on a vehicle loan, and there was a $550 payment. So in their case, it actually made sense to decrease the down payment and pay off the car loan. They could qualify for a bit more, but now we freed up so much cash flow.
Yeah.
So sometimes, like, I think it's better to just, be upfront, show all of it right up front for the pre-approval. And then let us kind of play around with the numbers to see if, like, maybe paying off the line of credit helps put you in a better financial situation. So I think where some people are like, "Oh, I want to put $100,000 down payment." I'm like, maybe not. Like, maybe we just put down 80, we keep a little bit and we pay off a debt. So now you have an emergency fund in case anything happens. Where I think people are just like, let's put it all onto the mortgage. Um, you kind of leave yourself up to liability. Like, what if your car breaks, you are off work for a little bit, maternity leave, like all of this stuff can happen in your life. So I think having an emergency fund is sometimes better than having a massive down payment.
Yeah, I think that's true. And maybe the reason why people think that way is when they initially think of a mortgage, it's a much bigger principal than, let's say, a car payment. So
Yeah.
they're like, hey, might as well pay that off first or as much as possible. So I'm going to save up more down payment versus what you suggested, paying off that loan, that car loan will actually free up more obligation and commitment on a monthly basis, right?
Yeah.
Because yeah,
Yep.
if the car breaks down, guess what? You still have to make your car payment even though you can't drive it, right?
Mhm.
So there's that
Yep,
aspect of it
exactly.
too. So for people out there that are thinking, "Hey, I must save a large down payment," like whether it's 15, 20, 30%, whatever it might be, um, it's always good to speak with a mortgage broker and really understand the financial pictures of everything because maybe you're right. Maybe how you've been thinking about it is absolutely true and it's what a mortgage broker would recommend, but still get that information so you can reaffirm your decision because if there were to be a better strategy and it could either end up saving you money or time, help you even have a better, a greater peace of mind, is that worth money to you? And it's something that you want to learn about. At least you can consider that as an option. And if it's, at the end of the day, not for you, at least you know about it, right? Because
Yeah.
if you don't know what you're saying no to, a lot of times that leaves strategies and benefits that are maybe missed opportunities because we talked about it earlier like how does wealthy people do things and well, there's strategy, right? As I mentioned. So this is one of those strategies.
And another thing, they don't wait to get the advice. Where I find there's a lot of people who wait until they're ready to buy. No, like, if you're calling me a year in advance, I am happy to talk to you. We work out a strategy. We look at it all up front. Maybe sometimes we don't pull credit right away, but we take a look at like a few of how you've structured your finances, and then I can help advise on how to get you to the goal or where you want to be a year from now.
Last question, Allison. This is a bonus question that I wanted to ask you on behalf of our viewers here is if a young family came to you today and said, "We want to build long-term wealth through real estate over the next 20 years." What would you tell them to do in the first 12 months?
I love this one. Because I did this. Don't buy your dream home first. Buy something that's comfortable, that gets you into a home. Get your hands dirty. Like, my husband and I, when we bought our first home, we finished the basement. We increased the value by 85,000. That helped us purchase the next home. Not our dream home, but it got us, a little bit further along. And then with that one as well, we also renovated it and moved up. And I mean, there's so many videos we watched on YouTube, but yeah, don't buy your dream home first. Buy the house that's comfortable, that allows you to invest in it, that allows you to build that wealth, and then move up.
Yeah, 100%. I think that even within our team here at Team Legacy, um, we really advocate for building wealth long term because, selling
Mhm.
you and helping you buy one house and getting you into a home, um, it's okay, right? It serves its purpose, but we really want you to build wealth through building your portfolio. Um, I would say you'll be in a position that you can have a stable and sustainable wealth building strategy. And if home prices are down, you don't have to sell now. When home prices are up, you can have a multitude of options that you're able to either borrow from, you could sell it and capitalize on the appreciation. But having assets is what really builds long term wealth. It takes time. You don't get rich overnight, but you also don't go poor overnight as well. It's based on um, decisions that you make and how you set up your financial future. It's very
Mhm.
intentional. It's early on
Yeah.
conversations. It's being proactive and having that proactive approach and awareness to be like, hey, are the professionals that I need to talk to help me on this journey? And Alysson, being the mortgage broker, is one of the pieces of the puzzle. There's going to be other professionals that you'll have to lean on that we have no issues as well to refer you to and recommend you to, because essentially your power team, they see it in different angles that maybe you're not equipped to see it because that's not your profession and that's not your specialty, right? We only know so much, and we're great at selling homes and buying homes with our clients, but we're not specialists when it comes to the financing side or the legal side of things. That's where we lean on our referral partners, right? So that's I'm very, very fortunate to know Alysson from Elevated Mortgages. And that's the whole purpose of this. And this whole purpose of the podcast is to really build a community and a network where people can chime into the podcast and seek information out of the conversations that we have with our guest that comes on the podcast. So once again, Alysson, I really appreciate you. Looking forward to um, working with you and having you help our clients and our agents to give them the upper hand when it comes to helping our clients thrive and build wealth in real estate.
And I appreciate you inviting me onto One Legacy podcast. It was really fun.
Yeah, 100%. I had fun too. So I can't wait to meet you again, and we'll do another podcast on a separate topic. But again, for our viewers today, this is our number one podcast. There's so much more that is in the store for us, and so many guests that will be on the show that will also provide amazing, amazing value to you. So thanks again. I hope you guys have an amazing day and keep crushing it in real estate. And we'll see you again.
Legacy. Stay with me.